Hi guys, how have you been doing? Thank you so much for being here. My name is Esther Nguna and this channel is called Finance by S. It's all about finance, all about investments, all about personal finance. Thank you so much for being here in yet another video. So welcome to the channel. So I have been getting a lot of questions and people want to know how to start investing as a beginner or how to diversify one's investment portfolio. And today I'm going to be talking about one of the main ways to invest in real estate without having to build up the capital to directly invest in real estate. And that is, I'm going to be talking about real estate investment trusts, shortened into REITs, that is REITs. So without further ado, let's get into the video. I will start with the definitions, and a REIT is defined as a collective investment scheme that pulls funds from different investors to invest in real estate assets or real estate properties. So they invest in commercial property, they invest in residential, in hospitals, in shopping centers such as malls and office blocks. So they invest in these huge real estate assets or projects that you as an individual and I as an individual will need like all my life to be able to accumulate that kind of wealth to invest. Okay, not all my life, but I will need a lot of investment capital. Yeah, in Kenya we have two types of REITs, and the first one is called a development REIT, and then we have an income REIT, a D-Reit and I-Reit. I'm using the short forms. So a D-Reit or a development REIT, from the title, this is a type of a REIT will pull funds from different investors and will buy land and develop that land to completion. Okay, while an income REIT, from again the name, I don't know if the name is suggestive enough, but an income REIT is a type of a REIT also that will pull funds from different investors and buy fully completed or completed income generating real estate assets. They will buy properties or buildings that already have tenants so that they can earn from the rent income that is already being generated, while a D-Reit will start from the scratch by developing first that property. So those are the two types, and the similarities of these two REITs is that both, first of all, is that they work the same in terms of pulling funds from different investors, and they all invest in real estate assets. REITs are mandated to invest in real estate assets. That's their mandate. Okay, the differences between a D-Reit and an I-Reit is that what I have just said, that a D-Reit will start from scratch by developing that property to completion first, and then an I-Reit now will buy this property that has already been built, and then an income REIT will come in. So an income REIT buys stabilized, completed and stabilized they buy complete and stabilized real estate properties that are already generating rental income, that already have tenants. Income REITs don't build, they don't develop, they don't build is the correct word. They don't build the property, they buy a property that is already built and has tenants on board. And the second difference between a D-Reit and an I-Reit is that a D-Reit is long-term in nature, and this means that it will take some time before this D-Reit starts generating returns to its investors. It doesn't take 6 months to put up a whole office block, a whole residential estate or property. It doesn't. So it will take about 2 to 3 to 4 years before now the investors get their capital gains, while an income REIT is medium term to long term, and this means that they pay their dividends in the medium term. They pay their dividends within 6 months. Most of them in Kenya pay their dividends biannually. So within 6 months, or in 6 months, you have your dividends. In another 6 months, you have your second annual dividends. The third difference is that a D-Reit will make most of its money through the capital gains it makes when selling this property. So as I said, a D-Reit will buy land, develop the land, bring tenants on board, and then sell this property to an income REIT. They develop and then dispose of to get the profits. So they make most of their profits from this capital gain when selling, while an income REIT will make most of its money from the rental income it generates every month, or however the period of payment of the rent. So an income REIT is monthly income driven, while a D-Reit is capital gain driven at the end of the process, which is selling the property. The fourth difference is that the D-Reits in Kenya right now are restricted to professional investors who understand how real estate works, who are patient enough to wait for the returns after 3 years, and also who invest. So a professional investor will understand that, I'm putting my money here. I understand how real estate works, so I don't expect this building to be completed in 1 or 2 years, and I'm going to wait for the capital gains. Also, the amount of money I'm putting in is not less than 5 million. Well, the income REITs in Kenya are open to both retail investors and professional investors. Any can invest, and the minimum investment in the income REIT is 10 units. So I just mentioned the word units, and I'd like to explain how they come about. So when you and I, as the investor, buy into a REIT or invest into a REIT, what you do is that you buy units of a REIT or shares of a REIT, and just like companies, you earn dividends, and you also get capital gain when the share price of the REIT goes up. So that's how they work. They don't pay you interest. No, you get your dividends, and you also get capital gains. So for D-Reit, as I said earlier, D-Reits will mostly pay you capital gains when they sell, because when now assuming a D-Reit buys land at 50 million, develops that land, puts up a property, and now the whole property is worth about 300 million. When they dispose it at 300 million, there's a whole capital gain. They've gained the profits. So those are what we call the capital gains. And then for income REITs, when you invest into a REIT, you're giving them the money, so they finance a project that is already complete, and they start generating the rental income. So this rental income minus the monthly expenses they incur, because the management fees, the trustee fees, and all those kinds of expenses, when they get the profits, they distribute to the investors, and this is what you get as a dividend from REITs. Why should you invest in REITs in Kenya, and not just in Kenya but anywhere? Why should you invest in REITs? And the first reason, which I'm very passionate about, is that REITs provide a channel. They provide a way for retail investors to start benefiting from the real estate, to start getting property appreciation, that is capital gains, to start earning monthly rental income without the need for the huge capital, for the huge initial capital that is needed for you to directly buy land or for you to directly buy property. The capital is a lot. So REITs provide a way for you to start benefiting from real estate without needing the huge capital, because they pull funds from different people. So that's a very, very big win for REITs. The second, again, a reason which I'm also passionate about is the noise. The chickens are chickening. Anyway, the second reason is that REITs are a good way to diversify your investment, because they first of all provide a diversified real estate portfolio. You do notice that a REIT won't just invest in one property. They are also very diversified. They're investing in maybe residential properties, office blocks, hotels and hospitals, and all hostels, you name it. So already they are diversified, and this is a professional investment of real estate properties, so they are diversified and professionally managed. And now you, with your other investments, you come into this well diversified real estate project or property. So they are a very good way to diversify and start earning you the benefits of real estate that is only preserved or reserved for the rich. The third advantage of REITs is that they're tax exempt, meaning that REITs don't pay income tax. They don't pay income tax on the income they generate. And this money, guess what? Where does it go to? Where does it go to? So my fourth advantage is that REITs are required by law to distribute at least 80% of their profits to the investors. So you're always assured of dividends. You're always guaranteed of dividends, unlike in companies where most companies don't pay dividends. However, it's very important to note that you as the investor will be taxed 5% withholding tax on the dividends, and that's the only thing you pay as tax, 5%. That's a pretty good deal. That's a very good deal. So with that done and dusted, you definitely want to know how you would select a good REIT. And the first thing is that you should know what you want as a person. And this is with regard to REITs. That is, you should define your investment objective. You should know what you want to achieve when you're getting into this REIT. This could be, I want to park my money here or put my money here, and then after 3 years get a good amount of capital gains. Or you could also want to start earning passive income. The passive income is very important to you. It's very important to everyone, but it just depends on the priorities. So you want to start earning passive income at least every year or every 6 months. Then you definitely know that an I-REIT would be more suitable for you. So depending on your investment objective, select the D-REIT or select the I-REIT. Okay, so when you select the REIT of your choice, please do your research. Do your very good research. Always do your research, as I always say. Do your research. You should find out the kind of properties they invest in, they finance. Are these viable businesses according to you? Do they have a market for them? The buildings they're building, do they have a market, or do you see them struggling with getting tenants on board? Are they diversified, especially geographically and even sector wise? Are they well diversified geographically, such that when a certain area the tenants are not boarding, at least the other areas are doing good, or they are well in demand? So you should definitely do your research and see if these buildings or these properties will get tenants that will generate returns for you as the investor. The third basis for selecting a REIT would be its performance. How is it performing? How has it been performing in the past year or in the past 5 years? Has it been growing, or is it something that is shrinking? So with that, guys, I have come to the end of the video. Please do subscribe. Why are you not subscribed? So please subscribe, please subscribe, and thank you so much for watching. If you have a comment, a question, please put it in the comment section and I will get back to you. I'll be glad to do so. So thank you so much for watching. I'll see you in my next video. Bye.